Hi, it's Matt Decker with Leveraged Wealth Management. You are watching the second product related video as it relates to our cash value life insurance series. If you haven't seen the introductory video to this series, I encourage you to start there. It's only about 5 minutes long. That first video really just lays the groundwork for this entire series and the conversation that we're having here. But today, we're talking about a specific form of cash value life insurance, and that is indexed universal life, also known as IUL. If you haven't watched the first video about variable universal life, I encourage you to do that because some of the things that relate to variable universal life also relate to indexed universal life. And those couple things are, number one, net amount at risk. And if you remember, net amount at risk is your death benefit minus your cash value. Death benefit minus cash value, and that equals your net amount at risk. Net amount at risk is what's going to determine the actual cost of insurance every single year because that's how much insurance you're actually buying. The second thing that applies to indexed universal life that also applies to variable universal life is if it's properly structured, your fees every single year should look something like this. They go up, they go down, they go side to side. Some years they're lower than they were the year before. Some years they're higher than they were the year before. But it is not, this is what's important, it is not a straight line linear up, okay? Universal life insurance policies, if structured the right way, the fees are not a straight line up, okay? They go up, they go down, they go side to side. At some point, they reach what's called corridor, and they level out for the life of the contract. Also, if you remember from our introductory video, if we are looking at all these cash value life insurance policies on a risk-reward timeline, the VUL was way out here, and an indexed universal life insurance contract is going to be right around in here. So it should be the product that has the second most upside potential, because again, this is risk versus reward, this being the most risky, but the most reward, this being the least risky, least reward. So we're talking about IUL, it's right around there in our risk-reward timeline. So how does it give us the second most upside potential, but yet how is it not as risky as the variable universal life insurance policy? Well, it's actually pretty easy, and it's a really cool feature of the indexed universal life insurance contract. All these policies have fixed accounts. So let's say that the fixed account on this indexed universal life policy is 5%. So every single year, the company is going to come to you and they're going to say, you can either take the fixed rate at 5%, or we can take this money that we were going to give you already and we can actually invest that in an index. So let's just say it's the S&P index. It's probably the most common index that you find in these indexed universal life insurance policies. So the conversation goes something like this. You can take a fixed account at 5%, or we can take this 5% that we were already pledging to give you, and we can invest for you in the S&P. And what are you going to get when we invest for you in the S&P? Well, you're going to get the upside potential of the S&P, but let's say it's capped at 12%. Yet you're not going to get any downside. There's no downside risk. 0% is the worst that you can do. And if you've ever talked to somebody that specializes in indexed UL, or if you've done research on indexed UL, you might hear things like 0 is your hero, it's an elevator with no down button. All those things are true. In an indexed universal life insurance policy, you get to participate in the upside of the market subject to a cap, without having to participate in the market losses. So if you purchased an indexed universal life insurance policy with an S&P index that had a 12% cap, every single year, your returns are going to be between 0 and 12%. Now, this assumes that your cap never changes, that it always stays at 12. It doesn't have to. That's the subject for a totally different video because it takes a long time to explain. This 12% cap, though, is going to fluctuate with interest rates. So if interest rates go up, your caps should go up. If interest rates go down, your caps are probably going to go down. But let's assume that you have a static 12% cap. Every single year, your returns are going to be between 0 and 12% based on the S&P. But that's only half the story. There's also a really cool feature on these index universal life insurance policies, and that's called annual reset. Now, what annual reset means is every single year, your gains are going to be locked in, and you're going to start a new crediting period. Let me just draw it out on a really simple timeline. So let's say that your index starts at $100. Okay, so that's the index that you're tracking. It's at $100. And this is, let's just say this is year 0. So at the end of year 0 or the end of year 1, let's say that the index has gone from $100 up to $112. Well, if you have that 12% cap like we talked about earlier, you're going to get a 12% rate of return. Pretty simple stuff. Now, what annual reset means is every single year, in order to get a credit, you have to do better than where you started. So at the end of year 1, we're at 112. So that's our new starting point. So fast forward to the end of year 1, the beginning of year 2, and let's say that our index went from $112 back down to $100. Well, obviously the market is down in that case, but since we have a 0% floor, we don't lose anything. We just get 0% in that year. But here's the cool thing about annual reset. Our new starting point is now back down to $100. So if we go from $100 back up to $112 at the end of year 3, that's another 12% return in that 1 year. So in any other product, if you started at $100 and 3 years later you're at $112, well, over those 3 years, that's a 12% rate of return. But in the indexed product, since we get to lock in our gains every single year, and since we don't participate in any market losses in down years, and then again we start back over at lower values to factor our credits, we actually get two 12% rates of returns over this 3-year period. And so if you're looking at the returns of an index universal life insurance policy on a graph, it's going to look something like this. You make some money, you get a 0. You make some money, you get a 0. You make some money, you get a 0. Maybe you make some money a few years in a row, maybe a big 0 year. But the point is you're always going up, you're never going down. So it's going to be like a stair step. Now, if you were invested in the market this whole time, it could actually look totally different. The market might have been up much more than the index, but in that 0 year, it might have dipped back down. And then same here, up and dip back down, up and dip back down, up, dip back down, up, dip back down, up. You get the point. And that is upside of the market with a 0% floor, meaning your gains are locked in every single year and you don't have to participate in market losses. For someone that already has the majority of their money at risk in the market, this can be a phenomenal vehicle to not only track with the gains of the stock market, but not have to participate in any of those wild swings and wild losses. It can be an excellent way to diversify from market risk while still trying to earn a healthy rate of return. But let's go ahead and talk about the number one problem that I see with indexed universal life insurance. And it's really unfortunate because what I find to be the number one problem with indexed universal life insurance are the agents that sell indexed universal life. Now, what I mean by that is not that all agents who sell indexed universal life insurance are bad. There are phenomenal agents out there and financial advisors that sell indexed universal life. The problem is, in order to offer this type of product, this indexed universal life insurance contract, the only thing that an agent needs is a life insurance license. And if you've never done any research on what it takes to get a life insurance license, it is embarrassingly simple, embarrassingly easy. You can probably study for the test over a weekend, go out and pass that test, and then be licensed to sell these products. So unlike the variable universal life insurance policy, where in order to sell a variable UL, you also have to have a securities license. So you not only need a life insurance license, you also need a securities license. Much more qualified, experienced advisors can sell variable universal life insurance policies. And all it takes to sell an index policy is a life insurance license. So I don't want you to mistake what I'm saying. I'm not saying that all agents who sell this are bad. What I'm saying is the bar for entry in order to sell this product is very, very low. And so what this results in is a lot of poorly designed products. And when I say poorly designed products, primarily what I mean are insurance agents who structure these policies to generate maximum commissions for themselves. So that is by far the number one problem when it comes to index universal life. It's uneducated agents who poorly design products in order to maximize their own commissions. If you're working with a bad agent who follows this path, a poorly designed product structured for maximum commissions, it almost doesn't matter what product you've purchased. It can be the absolute best index universal life insurance policy on the market, and if it's designed the wrong way, it's probably not going to do what you want it to do. Now, this problem doesn't just exist with index universal life. It actually exists with everything on this risk-reward timeline, every other product that's less risky than this index universal life policy. It just so happens that the IUL is probably the most complex vehicle on this whole timeline. And so not only is it the most complex vehicle, but the bar for entry is extremely low. And so what I have found is most policies that have been sold improperly designed, and what that results in is a policy that's not going to do what you want. So here's what I'll say about index universal life. If you have one, I would encourage you to get a policy review. If you don't know what a policy review is, it's really simple. Somebody looks at your policy and they're looking at a few things. They're looking at what's the death benefit, they're looking at the death benefit option, they're looking at the premium that you're paying, they're looking at the loan provisions on the actual policy that you've purchased, so on and so forth. The important thing here is if you have not gotten a policy review, it's time to get one. And I'm happy to help you with that. In fact, if you want a policy review, if you've purchased an index universal life insurance contract and you would like a policy review, you can send me an email, matt@leveragedwm.com, or you can go to our website, leveragedwm.com/contact-us. Fill out the form, it'll go straight to my inbox, and I'll give you a policy review and I'll let you know if you have a product that was structured the right way or the wrong way. If it was structured the wrong way, I will give you some options on how to fix that product. I will tell you the worst thing that you can do is to stick your head in the sand and hope that everything turns out okay. So if you have an index universal life insurance contract and you have not gotten a policy review, it's time for you to do that. You can contact me one of these two ways and I'm happy to help. Let's recap what we've talked about in this index universal life insurance video. Number one, these policies have a 0% floor with an upside cap. And those caps range anywhere from, let's just say, 10 to 16%. These policies also have what's called annual reset, which means your gains are locked in every single year. You can't go backwards, you can only go forwards. And every single year, you're going to look at the starting value of the index that you've chosen. You're going to compare it to the ending value of the index that you've chosen, and that's going to determine your credit for the year. And again, the biggest drawback or the biggest problem that I see with index universal life insurance policies is going to be bad agents structuring bad policies. And if you suspect that you have a bad policy, it's time for a policy review. You can reach me one of these two ways. I'm happy to help. I hope that this video was helpful. It's not meant to be all-encompassing on index universal life insurance. There's too much to talk about to do that in this video. I will cover other topics in subsequent videos, but if you haven't done so already, I'd encourage you to like this video, subscribe to my channel. I'm always coming out with different product reviews and going into more detail on different types of life insurance policies. Again, this has been Matt Decker with Leveraged Wealth. Thanks for joining me, and I will talk to you soon.